No.
Okay.
Yeah. Cool title though. All right, welcome everyone. Thanks for joining us. I was just checking if Chris, my guy here, was recording the video side of things, because otherwise, if it's not recorded, it didn't happen. My name is Mark. I am one of the co-founders of a group called NotCentralised. We've done a lot of work in the blockchain and AI space, and my co-founder is someone I used to work with before in the investment banking space in London. I went over there to London, follow my dreams. And when I came back, Arturo followed me with his family. I don't know if Arturo liked me more or the family, but, still TBA. But Arturo, do you want to give a bit of an intro?
I think you found your dream, right?
Yeah, yeah,
I came.
yeah.
Yeah. So I background is RBS and Merrill Lynch, structured derivatives, and then when I left banking, I jumped into the emerging tech space and have been dabbling in that space for quite a while. So it's been a journey, and the latest adventures have obviously been AI and blockchain related, but. Uh, Part of those adventures have been both to, let's say, play in the esoteric space of crypto, but at the same time being at the advisory board, for example, on digital assets for ASIC and for the RBA. We're part of Project Acacia, which is the tokenization play that they have right now, and it's really interesting to sit, in between both worlds of people kind of trying to make things up out of nowhere, and then other people trying to figure out how does that fit into an existing framework that is, as institutional as it gets.
Arturo did a lot of math,
Maths.
maths PhD sort of thing, and we did a lot of statistical work in banking, and it translates over to the blockchain and AI space. You mentioned Project Acacia, and I know Chris can't see it on the podcast here, but like, hands up who's heard of Project Acacia from the Reserve Bank of Australia? A few of you. That's good. That's two more than in other places that we've been at. So great. But Project Acacia is the Reserve Bank of Australia actually testing not CBDCs. They did that in 2023, and there were only tests. I say that with caveats because a lot of people get scared about this big bad bear called CBDCs. It's central bank digital currencies. What they're testing now in 2025 is, what does the world look like if the payment rails of Australia are run with blockchain, and the benefits of that. So we'll get into that a little bit more, but just by background, covering both the AI and blockchain sides of things, because this talk is going to be a lot about what's happening with Project Acacia, the engineering work that's going on there, and whatever we can update. But it's also just to show where there's this intersection between blockchain and AI. We have a lot of great systems out there. Australia is a very lucky country, not just for the beaches, not just for the lifestyle, but we, in terms of government, in terms of businesses, in terms of payment rails and finance, we are far better off than many other countries. And whilst we are in this kind of advantage kind of system, the government is still looking, and it wouldn't be if not for approval from Michelle Bullock, the RBA governor, who is often in the news for setting rates to the good or bad of the nation. But if it wasn't for the RBA's approval of this kind of testing, we wouldn't be in a position where we are now, where we're actually getting to show with real businesses. So 2 years ago, maybe let's go back to what happened there. We wouldn't be able to showcase a whole lot of the innovations that we will just take for granted as businesses and as people working in companies. And we'll talk about the advantages of blockchain. We're also going to talk about AI, where it comes into it. And towards the end, it'll be where AI helps blockchain. AI helps so many places. If you wanted to understand what we're talking about, run it through ChatGPT. We built tools in other places that you can actually access for free that help with this kind of stuff. I didn't mention at the start, but we run something called the Australian DeFi Association that has meetups every month here in Sydney. Hands up who's heard of that one? Okay, the same two. Very, very good. I like you
Who's
guys.
heard of DeFi as a concept? How many crypto blockchain people do we have?
Okay, a few of you all in here. So
Okay.
decentralized finance. It's where you're using the benefits of blockchain to help in what you're doing in finance. So there's a lot of crypto coins and a lot of scam and a lot of that kind of stuff, but underpinning the technology used for good is proving its worth.
Good scams.
Good, the capitalism, is it? Uh, let's talk about back to 2023. What was it that the RBA did back then in terms of the test? Because I think it's really important to know that, we're not just resting on our laurels here in Australia. We're actually doing further testing to go, oh, how do we actually improve this system? Because there's things like delays, there's things where, just current forms of money just don't work that well. What was it?
Yeah, so in 2023, the RBA had a specific exercise, and it was let's call it a research project. That's effectively how they're treating it, as they should. Trying to understand what it would look like to create a CBDC. So uh, let's just define what a CBDC is. It's not a well-defined term, so I'll just give you my own definition. But it stands for central bank digital currency. Now, all central banks, since a very long time back, since we used computers, have had digital money. So the concept itself is actually not new. Although there is a separation, right, between actual physical cash and then that central bank money that none of you have access to.
Physical cash. There was a gold
Right.
coin here. You
Right.
don't often see these.
Right.
Like, this is a historic item, folks. I'm just going to put it back down.
But then it's digital cash, right? And we think of digital cash as the balance that we have in our account with one of the banks. That's not cash. That's credit, right? It's a deposit. It's an IOU that the bank, holds. They give you an IOU to hold your money so that they can then go do stuff with it. So
you don't really own the money in your bank account, is what you're saying?
No, I mean, there's a legal relationship between you and the person or the entity that holds that cash for you, right? But it's not your money until it's in your pocket, in a way.
Is that why there's like all these lines outside of ABC Bullion down in Martin Place? I don't know if you guys have seen this in the news, but the lines are stretching past the Omega store, past Caffeine Cartel, great cafe down there. And it is like 20, 30, 50 meters long at one point. At one point, I think it got down to the fountain down at Martin Place. And people every morning are trying to, and at lunchtime, because, what better thing to do at your lunch break, trying to buy gold.
Buy gold, yeah.
Yeah.
Yeah, I guess, yeah, that's part of it. And the other thing is that it's worth around 4,000 US, right?
Pretty valuable, yeah.
But the thing with the CBDC is that although we do have central bank digital currency, it's only really available to a very select few of institutions that have ESA accounts, effectively, that are banks, and therefore can directly engage with the central bank. And what that exercise was about was understanding, well, what happens if we mint or create a digital currency that is accessible to, or accessible by others that are non-banks, not retail, but still financial institutions. And
retail, basically, mum and dad investors, they're not buying the CBDC.
Nor has the bank expressed any direct interest, let's say, in offering a retail CBDC at all.
Just taking us back to the narrative that was around at the time, and if you watch crypto news or go to events, everyone was so anti-CBDC. But first of all, to your point, money was digital anyway, or money, sorry, is digital right now. So
credit is digital.
Credit is digital. Sorry, it's credit, it's not money. But like there was fear that if you have the central bank issuing you these programmable tokens, they're going to watch your spending. And Chris here, who wants to spend money on a new camera, gets told by the bank, no, you can't spend that. And the thing is, that's if it's like for retail, but it wasn't. And the other thing, considering, would the RBA do this? Do you think the RBA would want lines, outside the RBA where people, mums and dads, are complaining about all this kind of stuff? They wouldn't. So they would very likely not go down this path. And they confirmed it later on after those tests were done in 2023. But what was the project that, we did? Because they wanted to test different use cases. One was, well, what if, I don't know, an EMP hits that turns off all the electricity and stuff, and you can't have anything electronic? What's an offline version of this going to look like? That was one of the examples. The banks did some other tests. What was our test?
Yeah, so we showed how you could streamline payments within the construction industry value chain. And that was a really interesting one because, companies within construction, they blow up quite often.
They
And
were blowing up back then. I think like 2,500
yeah,
over the course of 2 years blew up over COVID
yeah.
for some reason.
Well, as we did that study, the reason was basically that there's a lot of unstructured commercial relationships, right? So in principle, you get into a building type of engagement, and you end up with unlimited risk, right? It's the cost plus type of idea. Where if you're in a financial institution, you'd never enter into a relationship like that because you have much more structure, you have processes, both legal processes and systems processes, right? The legal processes that ensure that you don't get into unmitigated risks, but then also the systems that do things like daily margining or the likes. None of that really exists.
Protections.
Yeah, none of that exists within the real commercial world, and definitely not within the real estate or construction industry.
There's a lot of like podcasts, or not podcasts, but like even just little mini documentaries where ABC News and the Four Corners reporting would show things like where builders had collapsed, mums and dads were left with deposits that were just like that were gone basically because they had no idea what the funding situation was like for their counterparties. So if I'm a builder and I'm trying to do some work and I've got subcontractors, I had no idea at the time, and still to this day, whether or not the others behind the scenes actually have the funds to do the work that they need to have, nor do people that are relying on me to make payments. I mean, right now in the world, if you're employed, congratulations, but if you're employed, you rely on the business that's paying you, your employer, to have those funds at the end of the day. You don't know. You work for your 30 days or your 2 weeks, depending on your fortnight, your pay cycle, but you have no idea. And look, I'm not saying that your employees need to show you their balances, but in a business sense, escrows were something that people were doing. But escrows in the current world are expensive. Accountants, lawyers, the bank needs to get involved. But how does that change when it comes to using blockchain?
Yeah, so where we ended up, and that's perhaps a bit of a segue towards Project Acacia, is that we really took it back down to the principles of what a blockchain is, and a blockchain is nothing else than a shared ledger. So think of it as an Excel sheet that everybody's just collaborating on. And imagine the number of fuck-ups that one person does on one Excel sheet. Imagine if everybody was playing on the same Excel sheet. Like obviously that wouldn't work. And therefore, for that shared ledger to be useful, we had to come up with methods, and we, I mean the community, we as human beings, had to come up with methods to create high integrity in that data, right? So that's where cryptography comes into the picture, and you can effectively have immutable records that are time-stamped, and you can trace exactly who has done what, and then you set permissions as to who is allowed to do what and so forth, and all of a sudden we have a shared ledger that actually works. Now, why are these shared ledgers important? So for example, if you are setting up an escrow and you can program a ledger where you have the representation of money, then all of a sudden you don't need to have all of these third parties to be able to set up the legal infrastructure and the accounts and all these things and these fragmented systems to collaborate inefficiently in order for funds to be safe. All you need to do in principle is to deploy a set of smart contracts onto a blockchain, and then you can trust that the rules that you have set in those smart contracts will be honored, and therefore you're okay with that as a principle, right?
Just backing up for folks that might not know, smart contracts, programs that sit on the blockchain that just run automatically somewhat.
Yeah, think of it as I don't know, I'll say a SQL database or an Excel sheet. So actually, let's take an Excel sheet. Um, you have all of these different cells. That's the data in these cells, and let's assume that these cells are then accessible by a large number of people. A smart contract is nothing more than a macro within that sheet that has specific set of rules over how you move things within that Excel sheet. It's just that blockchains are more sophisticated than that, but in principle, it's the same thing. So just in the same way as today, a lot of finance, even at the institutional level, lives on Excel, literally. And what they do is that they send information as an extract in CSV form via email, or maybe on FTP if they're really, really sophisticated.
I was going to
And
say it's pretty scary if you come to think of it, just how much of global finance, the billions and trillions of dollars, relies upon people not making mistakes with Excel. So just
yeah,
have a think about that.
yeah. So in this case, the two parallels are basically saying, well, look, version one, you have your Excel sheet, I have mine, and I get money from over here, then I need to send some money to you. I send you that money, I will keep my books in my Excel sheet. I will then send you an email with a CSV output and say, look, I've sent you this amount for this reason, and then you take that information and you do your book balances on your sheet, and then we'll call each other and say, do we match? Like, that's the principle of reconciliation, right? Uh, version two, which nobody does because it doesn't work, is that we use our own Google sheet, and we're balancing things, which sounds like it's more efficient, but it actually isn't, because he will make a mistake, I will make a mistake, and all of a sudden, like, it doesn't work at all. The third version, which is what we're actually seeing the value of in terms of tokenization and life cycle management of financial relationships, is that we just use this shared ledger where I do things on my end, and he is programmed to link to these things on my end, which then means that his books automatically reconcile because they react to these events that are happening based on what I said is happening over here,
So
right? So
no,
it's
no more waiting of like,
no,
oh, my accounts person wasn't in, so I couldn't pay you.
no,
It happens.
yeah,
They
correct.
call it atomic. It's not quite atomic. One has to happen before the other, so it's almost like instantaneous, but pretty much it is automated.
Yeah, and then you can go a little bit further and say, well, yeah, sure, I could do that with APIs today. And you could in principle, but it makes life much, much more complicated, because at the end of the day, APIs are really fragmented, or no, they're very non-standardized. And then on top of it, as Mark was saying, we don't have that concept of atomicity, which is actually really, really important. So atomicity is a concept that we've had within databases for a very, very long time. So for example, you wouldn't run a database that doesn't have a specific type of ACID transaction, as it's called, where you know that once you've made a change to the data, for example, that you can batch a set of changes to the data, and everything will execute, or nothing will execute at all. That's really important. For example, I want to make a split payment where I'm sending money both to Mark and to Chris, but I want to send it to them simultaneously. And if one doesn't work, I don't want the other one to have settled either. In a trading scenario, we're exchanging, for example, a set of tokens. Let's say that one token represents US dollars, the other one is Australian dollars, and we want to make sure that if I send him AUD, I will get USD in return. So that's the concept of atomicity that blockchains do really, really nicely. Now, you can't do that with APIs, because APIs means that I send something separately, maybe instantaneously, but not atomically. He sends something back to me, and in most scenarios, we would get our tokens, swapped at the same time. But if he doesn't send it to me, then I've already sent it, and we have a broken trade, right? So that's the thing with the value of a blockchain, that you can actually have that interaction in a very, very high integrity format, right?
So just to add to that, what we did in 23, and we'll get to the project we did now. It was a very small scale type thing. It was literally a commercial builder doing tiling work, and so there was a legit project. There was like others that were just doing test transactions, sending it, but from one bank to another just to test things. That's cool. This one actually paid for a piece of construction work. Now escrows, when we talk to builders, they wouldn't touch escrows unless it was like 100,000, it's a six-figure and above kind of project. It's just not worth it. But for this one, for a $20,000 tiling project where they would never touch escrows, so they would be doing work unprotected, they had three escrows, three tranches of payments that where the blockchain, it was just the transaction costs and yes, sure, our cost of setting up the system. But to do those escrows, to do this atomicity type payment, and done in a way where it wasn't owned. So blockchains are transparent. That's another thing that you can see the transactions on the Bitcoin blockchain, on Ethereum, on these other major blockchains. Now, this led to a really interesting thing that we had to get into, because it's great that blockchains are transparent, but how the heck is that going to work if I'm doing work with, like, let's say myself and Chris, and then Arturo can see just how much was being paid for? I don't want that. We don't have commercial confidentiality. We need that, and we have that in our current system. So that was a thing that we face as a very real issue. If blockchains are going to work, you can't just have everything visible, because even if you're not seeing what the names of the transactions are, if you can identify someone's wallet, and let's say it's a cafe because you're paying them in crypto, and then you see on the cafe's ledger $5, $6, $7 for a matcha because it's popular, and then all of a sudden it's a $20,000 transaction, and I can see a new coffee machine there. I'm like, okay, I'm pretty sure it's that new coffee machine that they've got. And if I click on that wallet's address, I can see the chain of transactions for that. So you can pretty soon identify each other, which is not how the real world works. So how did we overcome, let's call it the commercial confidentiality problem that is inherent to what was inherent to blockchain in 2023?
So if we go back to the analogy of that Excel share sheet, the shared Excel sheet.
He's good with numbers, not words.
You can have scenario one, which is I have my own sheet. Scenario two, which is you and I share one sheet, but only you and I share that, and we do stuff on it. Scenario three is that we all share on the same sheet. That's a public blockchain. Now, if we're all sharing on the same sheet, then everybody can see each other's cells, and that becomes a little bit problematic when it's money that we're talking about. So there's a lot of innovation in this space, and one of these innovations is called zero knowledge proofs. So it's almost a branch of cryptography that allows you to effectively not share the data, but share a package that says that my data is what I say that it is, and I can prove properties about it without actually sharing all of the data.
So imagine like a license, for example. If Arturo is the bouncer and I'm trying to get into a club right now, I take out my license, digital or physical, because we still have those. And Arturo can see all the information on there. Now imagine a future world where with the zero knowledge proof, Arturo can ask me a question. Am I over 18? Am I a current New South Wales resident? Sorry, do I have a legit license? All of these things. He doesn't need to see the data, because effectively what he gets is a proof that says that I am.
It's a mathematical proof.
It's a mathematically proven proof, and maths is good, but we don't have to move data around. And that's a massive kind of concept when it comes to sharing information.
Especially private sensitive information. So we implemented that technology so that what we were using the ledger for was effectively to store these proofs, so that there was an auditable, let's say, track record over these transactions, and therefore we could have the integrity of that monetary flow, but at the same time not share that with the rest of the world.
So it meant that you had the best of both worlds, folks. You had blockchain to do programming with transactions in an automated way, but not giving up the commercial confidentiality that you need on the other side, because otherwise why would a business use it if all their margins will get exposed?
Yeah, I don't think privacy is a bad word now. We used to use that commercial confidentiality term because privacy.
We couldn't. Okay, we weren't allowed to say privacy, because in the blockchain world they're like, what do you mean privacy? Like, no, you show everything. But the problem is that just speaking philosophically from working in the space for the last 5 years, blockchain has been great, and they're very innovative, and they do things really fast, and they break things, and they test, and they build. But the problem is like, that's great, but here's how the real world works. And it's not that everyone in the real world is going to move to blockchain. It's more like, how does blockchain become part of the traditional finance system? So going back to what we tested in a small way with a real transaction, and it was backed by the RBA. The money that we got to do that was from the RBA. They commissioned us to have that $20,000. I believe it was the first construction payment made by a central bank using blockchain. So that was a pretty significant thing. But fast forward to 2025, and that was one little part of a transaction. It was just a payment between two parties, builder and contractor. But now in 2025, you've kind of expanded that a little bit more, where it seems like it's more of a value chain. Now, can you explain that value chain in words that non-finance folks would understand?
Yeah, so when you're taking taking a mortgage, for example, then you'd go through a company, a mortgage originator, that will, they'll offer you that loan, but they need to then find money to pay for that property, right? And usually what happens is that uh, the originator of that loan will have a relationship with the bank, and the bank will then say, here, we'll offer you a credit line, effectively a warehouse. And the originator then starts finding more and more properties to lend against, or lend to, sorry, borrowers. And that's here we have two companies already. Then as all of these loans get put into a warehouse, then they get so-called termed out. Effectively, what happens is that they move from structure A to structure B. So a trustee comes into the picture and they set up a fund.
It's
Right?
sounding very Big Short to me right now.
Yeah, well, it is. And the point of the story is that there's many different parties that are effectively collaborating so that that person that is taking the mortgage can actually get money, right? And what we're doing then within this pilot is just showing how you can effectively use a blockchain to make this entire value chain so much more efficient. And the efficiency comes in terms of the instant money movement, and uh, the benefit of not even needing to reconcile, because you're reconciling automatically everything that's happening within that value chain. Now, reconciliation is like super boring, but at the same time, it costs big banks hundreds of millions of dollars in aggregate, because of the amount of operational errors, of tech resources they need to throw at trying to fix bad systems, right? Systems that effectively go down to COBOL code that was written in the 70s, and then you just patch up a bunch of stuff.
If you know how to write in COBOL, you could earn a lot of money, even though it's a very, very old language. But those engineers, they bring them out of retirement because the banks are built on these old systems. I mean, you look at the ASX trying to do chest replacement, and they're trying to move it to blockchain, but it was such a hard thing to do. And they'll re-look at it again. Like, it's no doubt that all these systems will change. But yeah, it's a very difficult. All old systems are very difficult.
Yeah. So that's effectively what we're doing. We're showing how you can use this shared ledger to increase the quality of communication and transfer value between these counterparts that are moving a lot of money, and are actually offering a very important service to the overall community, which is access to capital for, everybody lives on credit, so you need to provide that.
I was going to say, I realized I probably should have put slides up because we have a really cool explainer built with AI, and we'll talk about the AI side of things, that shows this thing going from invoice creation to people, these institutions taking those things and turning them into fixed income, and then people buying those bonds, and then like the whole kind of value chain. And it's probably one of the more complicated things. If you just remember Project Acacia, so ACACIA, that's what the Reserve Bank of Australia is running, and we're one of the participants on. So I guess we're doing this with a bunch of different groups. It's not just us that are doing it, because you need to rely on different counterparties. Who's the blockchain that we're building this on?
Well, we're using a blockchain called Red Belly, which is it's actually Australian innovation coming out from Data 61, CSIRO, and University of Sydney. And then they also have some very important properties that are necessary if you're doing financial transactions of high value, which is, very high throughput, but also it has technical properties that just make sure that you can rely on finality, financial finality
So
coming
what's
from
interesting is that, you're saying that they've got the technical aspects there.
yeah.
One of the biggest complaints of blockchain was that it was slow. Great that you could program, great you had security, great that, you had this visibility, but with confidentiality. But the problem there was that it was slower than just doing a normal transaction. But recently, like last couple of months, last couple of years, they've had throughput, and what that means, the number of transactions per second that actually beat the group that is powering this podcast stage
Yeah.
called Visa.
Yeah.
So imagine that you've got a blockchain that is faster than Visa in terms of transactions, that has the security, that has all of these other properties, and you've got central banks around the world doing tests on that kind of stuff. And this is all kind of like underneath, like it's in the AFR and it's in some, esoteric like tech blogs, but it's not really mainstream yet. We actually tried to get the RBA to come down and be on this podcast with us. They had to decline for various reasons, but they are talking about it, and it will be having a research report written in the new year, early new year, because when does this finish, this current project?
Yeah, this end of the year is the target.
Okay, so straight away after this, you've actually got to go back to doing work and coding it all up, right?
Yeah, what's work?
Okay, yeah, it's fine. Enjoy the rest of the festival. But what does it all mean? Okay, let's take a big step back. Great, around the world there's these tests. You hear about tokenization of, for example, the latest trend is tokenizing stock markets. So
Mm.
the London Stock Exchange, New York Stock Exchange, NASDAQ, and maybe the ASX will come back. They've been burned by some blockchain stuff that didn't go so well. But tokenization is something that they're looking at there, so that they can have stocks not just trading between the market open from like 9 to 4 in the US, etc., but 24/7.
Mm.
What does that mean if things like that? That's just example of one market, but what does it mean if that's all of a sudden tokenized?
Um, there's the good, the bad, and the ugly, right? 24/7 trading doesn't mean that things get more liquid. It could actually be the opposite, simply because there are scenarios where the fact that people have specific times during which trades can be submitted means that you will concentrate the liquidity, or concentrate the ability to trade over that trading window, which then means that everybody then just agrees, okay, if we want to do something, we will do it now, as opposed to at any point during the day, which kind of fragments that liquidity. So I think that it's important to understand that not everything is about increasing liquidity per se. But what it does do is that it increases the ease of transfer, the ease of tracing, let's call it the lineage of the data over what's happening, and most importantly, it's the ease of integrating services. So that last piece is one of the most important ones, because let's consider Circle and Tether, right? I
They're
think
big companies that make stable coins. So stable coins are things that they're not crypto that goes up and down. They're just stable because they're back to the US dollar. And it means that you can do programming, but with something that you can ensure the value is $1 at a time. And Australia is doing their own versions. We didn't have ones before, but now we have groups that are getting their AFSL licenses, and we'll be doing a lot of stuff very soon. Sorry.
so. If you look from a business standpoint and the valuations within the Web3 space, and I'm not talking about the meme coins, I'm talking about actual businesses that are trying to set up within the space, valuations are really high. And the reason is because I think that there's a functional reason behind that, which is going back to the benefits of having that open network, and the ease of connectivity, which is where I kind of started the thought process with. And it's that you have Tether. Tether is now valued at, I think it's $500 billion. And
That's bigger than CBA, I think.
oh
Is it?
yeah, it's bigger than, I think that it's right by JP Morgan in size.
For comparative, the whole Australian ETF market only just cracked 300 billion. That's AUD. That's not
Yeah.
USD. So it's
Now,
twice the size of that.
there are many reasons why that is worth or it's valued rather at what it's valued at. They make a lot of money of the interest that they're carrying, and it's making a lot of money. So there's a reason. But the point that I want to make is that USDC and Tether are very simple products. It's a token, right? It's this thing that anybody can buy, but anybody can buy it. And without concerning ourselves with the realities of KYC and AML and so forth, if you just think of it from a systems point of view, what they've been able to achieve is effectively this one product that is integrated into millions of different financial services, and they don't even need to have a relationship. Again, I'm not talking KYC AML, I'm talking about technical ability. They've been able to connect, no, sorry, others have been able to connect to them without even needing to have a relationship with them. That is the level of efficiency in terms of connectivity that you get through the standardization of using these open networks.
And going back to it, like why people want to use stablecoins, imagine that people getting paid working remotely in Asia on projects from overseas and getting paid in stablecoin in USDC, but then they can actually transfer that instantaneously. They don't have to download it. They could actually transfer that to their friends, relatives, and others using the blockchain network of connectivity and stuff there, instead of like waiting for Western Union, waiting on T+2, which is like, the payment happens, then 2 days later it settles. Like, so they can do things with that and get paid from services overseas that don't need to set up all the, and you contact institutions, like you're saying, they could just literally connect to these networks, get payment, do something with that money, and actually transfer value in a way that, we'll take for granted when we look back 50 years and this is just how it is normally. So yeah, they're very interesting. But anything further on the valuations?
Well, it's just the appreciation of how having a shared ledger as the way in which you engage and communicate with your customer base increases increases your TAM, your potential customer base, but it also decreases the amount of effort that is necessary for a customer to engage with your product because you're using that standardized technology. And not even a company like Stripe, for example, which has done incredible work and kind of kicked off, in my mind, it's personal view, kicked off the fintech in a way. They haven't been able to achieve the level of integration that these two companies have over a much longer period of time, right? I mean, Stripe will power a lot of the e-commerce space, but Tether and Circle, they will power emerging market economies,
Yeah.
right? It's a very different playing field.
Yeah, they're doing a ton of stuff, and to the point that PayPal, Stripe, Visa, MasterCard, all of these payment networks, guess what? If they thought the blockchain was bad, they're actually doing stuff in this space. They're actually getting into the stablecoin world. PayPal has even created their own stablecoin. Now, arguably, it is not as open yet. Only is on the PayPal network. I don't know what Stripe will do, but they're getting
Yeah, Stripe bought Bridge, which
yeah.
is a build your stable coin as a service kind of thing.
I
So
wish we were Bridge. I wish we came up with that. But in any case, we are here. But
$4 billion valuation on that acquisition.
that's not too bad.
Yeah.
We could yeah, wow. Anyway, we would have robots here doing all this stuff for us. But going back to it and the valuation being important, one interesting factoid is that before all of these banks like and BlackRock and Franklin Templeton and all these big names in the capital markets world got into this space, the majority of users were these mums and dads, gig workers, people just wanting to make payments in the blockchain network that they're on. We did some blockchain projects early in 2021, and we got paid in stablecoin. Then we had to figure out how do we take that out without going through the banks to actually transfer it to us. There were services out there. In any case, I'm saying all of that because the majority were what they call retail. It's only just happened in the last year that the majority of stablecoin usage is now institutional. It's transferring payments from JP Morgan in one country to JP Morgan in another. It's all of these big bank, big commerce organization use cases. And with this wave that's coming in, it's just going to grow because there's so much, as we know, if we're going from like shitty Excel spreadsheets in terms of doing things, imagine more and more organizations are actually getting in and using stable coins. It's what they would call a headwind, sorry, tailwind. That's the opposite. I like to use the opposite word sometimes. It's a good positive thing for this space. So, I just wanted to leave off the stable coin with that.
Yeah, yeah.
But
And maybe the space that it's good for is not the stablecoin space per se, but the space it's good for is for traditional finance. It's for actual businesses that are offering services that add value to people, and they have then found a better way of adding value to their customers because they can more efficiently do so using these new forms of payment.
Absolutely. I think going to the next topic that's part of all this, and it's a twofold thing. One is how does AI help the blockchain world that we've just so well described there, and vice versa. And it's not often thought about how blockchain helps the AI world, but it does. And it's interesting in some of the ways that we look at that. But let's just start off with the easy one, the free kick, so to speak, which is how from the blockchain world that you described, how does adding AI agents, these automated, things, how does that help the blockchain space that you've
Look,
described?
I think that we can reframe it, and instead of thinking of it as how does AI benefit blockchain or blockchain benefit AI, it's about how do people find benefit in the tool, right? In the blockchain tool or the AI tool, and how can we increase the benefit for the customer or for the user if we use both tools at the same time for the right reason. And one of the big problems that we find with AI is that it's a little bit too easy to use, and it'll get you to, let's call it that 50% or that maybe even 80% really, really fast. But the last 20% is the critical piece, and yeah, you can just get careless and implement. So we need to have much better processes for the integration of these AI workflows, and typically that means that we actually just have to follow the similar processes that we have within big organizations. For example, if you are within a financial institution and you're going to transfer more than $100 million, then you need to have X number of people agreeing to that and signing off and yada, 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 right? Naively, you'd think, oh, well, I just have an AI that has the rights to do so, and they'll just do it. And then all of a sudden they transfer $1 billion instead of 100 million. A person can also make that mistake.
Oh, it was a hallucination
Right?
though.
Yeah, but people hallucinate constantly, right? So the problem is not the AI itself. The problem is just how we're using it. And we've already solved the inconsistency issues that we have with, let's call it hallucination, applying processes to people. And here it's about applying those processes to those AI workflows as well, right? And where we have found a lot of success in addressing those things is effectively by using as a blockchain as a policy engine. So effectively that means that you separate the intention of the AI agent and you say, well, the AI agent can almost say whatever they want, right? Usually they're quite smart and they won't, but it could happen. And the agent then doesn't do anything. They intend to do something. They create this job, let's say.
They
That
plan
job, yeah,
or something.
that job then goes into this policy verifier where the policies are on chain, and if it's value transfer that the intention of the AI agent is meant to do, then again that also gets passed through a high integrity database, which then is that database, right? That is the blockchain.
So something that we found, and we've done. So we mentioned the RBA projects that we've done there. We built in and consulted in the AI space, and one of the things that we built was a tool that needed to solve that problem of where AI is not doing the things you want it to do. Like if it was doing a summary for Arturo, it'd be paragraphs. If it's doing a summary for me, it'd be dot points. So building into that elements where you have these guardrails that say, here is the way that it needs to be done. And we had some papers that, had some documentation there in terms of what are the best ways to do that. If you're technical here, look at something called Markdown. I know we're talking about like MCPs, that's the latest kind of trend in the AI space, but Markdown is really king there. But I'm saying all of this because we built something that X15 Ventures took a look at and brought us in along with 20 other businesses to legitimately see what these things could do for CBA. And we didn't get too much further than that, but they did invite us back to give some keynote kind of talks at their offsite. So good relationship there. But I'm just saying all of that because some of the things that we found in terms of like you've got it's generative AI that I'm talking about too, by the way. I'm not talking about machine learning and all of this traditional under the bigger umbrella of AI, but the more recent ChatGPT, large language model stuff that's based on probability. And where because it's based on probability, it means that it can potentially get these things wrong if you don't review it as a human in the loop, or better yet, having experts in the loop that know what they're doing, not just any human. But even with all of those processes, I mean, blockchain helps out a lot there, doesn't it?
Yeah, so the probability piece, I think, is not a problem. I mean, I find AI more reliable than most people that I work with, right? And
We like to think we get things right most of the time more than a machine, and that we trust a person driving the car
yeah,
than a machine. But the stats show
yeah.
you're right, like it's
I mean,
far lower.
I trust it more than I trust myself in many scenarios, right? So I don't think that's an issue. I think that the issue is more that we just don't really know how to use it in a safe way. And part of that safety is also the attribution of the output of the AI. So here we go back to the concept of identity of sorts, right? And blockchain has a very interesting take on the concept of identity, because every time you do a change on the shared ledger, i.e. the state of the thing that you're trying to do, you need to do so with a so-called private key. So you're kind of forcing in the concept of identity into every action that you're doing. Now, the interesting piece is that because identity is forced into and is standardized at that shared ledger state, then we've built a lot of tooling to deal with that identity. And part of that tooling is concepts like, for example, you can have delegated identities, right? So I can then say, okay, well, look, if my company policy is that AI never acts on its own, it is always acting as a delegate of an individual, which, by the way, also solves a lot of the regulatory issues that people kind of think about. Oh, does AI have agency? What if the AI says something and it's wrong? And
You always have a human to
right,
blame,
exactly.
basically.
Well, I mean, the entire legal system is based on the premise of being able to blame an actual person, right? So sure, you have the concept of a company that has personhood to a certain extent, but that, there are directors, and there is always someone that you're able to pinpoint and has that responsibility.
I reckon blame human AI would be like a great name for a company.
Yeah,
So,
probably.
watch, someone might copyright that, but anyway.
Now, the thing with let's call it the interaction between AI and blockchain is that if you accept that almost as a design policy and a solution that you're building up, then what you do is that you always ensure that a person that is engaging with the system has that identity, that is that private key to engage with the system. An agent that is acting needs to act on the behalf of that person, which then means that you can effectively create a separate access key that is specific to this agent, and then you set policies on this access key, and that gives you the safety that if you trust that these agent and these sets of prompts are really good at, let's say, I don't know, paying invoices that are less than $100, right? Which, you don't want to spend your time doing it. Then you can create this access key that the agent uses. It does it on your behalf. Nobody really even knows that it's an agent because it's using your identity, but with specific policies.
You're responsible for
You're
it.
responsible for it, right? And you can then just let that go, and it'll be good for you, right? It adds value to your day.
I think that responsibility thing is an interesting one as well. And if you guys remember earlier I think it was earlier this year, the government came out with a consultation on here's some ways that we're thinking about AI, let's industry respond. And before that, they even had something where it was just a shorter consultation going, well, what is high risk usage? Should we consider doing something where it's in finance, financial advisors, it's legal, it's lawyers using it, or it's healthcare, it's GPs using AI? And what we responded with, and we were actually testing this with systems at the time, and this is the advantage at working at the intersection of new technologies, because you can see what they're good for and not good for, and you can legitimately test these things. But imagine that you could have something where in the future, I don't care that my GP uses AI. I don't care that they do
Probably
this.
want them to use
I
AI, to
probably,
be
because they
honest.
have all of these advantages of information that's not just in their head, but it's, from all these other sources. But at the same time, I want to make sure that they're actually reading the output. And so something that we tested was the concept of a micro signature, which was a way that you could stamp within the app that signs onto a blockchain that can't be tampered with, and where the data that sits inside of that, only parts of that, remember the license thing that I mentioned before, it's only parts of that information that is shared necessarily. But recording things on a blockchain that I, as a human or an expert, better yet, an expert in the loop, has signed off. And if it was to be audited, we could showcase that. And so that was like one big way early on that we saw, hey, blockchain can actually be a proper system within this AI landscape.
Interestingly, though, it was a tech solution, but it was more of a behavioral hack that just triggered people, forced people to
We like
properly
triggering people.
engage, because you kind of you're forced to sign off on something, as opposed to, if you're not forced, it's so easy to just get the output, look at it, think that it looks okay, and then just send it forward. And
If you
it's
have to
fine.
sign something,
Yeah.
you realize all of a sudden just how much more care you actually have looking at that document. If you had to sign, well, I mean, in most cases, it should be the case, but I still know many people and myself that just scroll through T's and C's and just hit accept because I just want to get to the app. But forcing people to have that behavioral change, there were even studies where even if ChatGPT, even if other tools show you the sources of information, the majority of people don't check it still, which leads to Deloitte type mistakes. If you guys remember them getting that fine, I don't know how much they paid back for the
I
final
think it was
milestone.
400K.
400K for the whole job, but I think they had to pay back a little bit of that. So poor Deloitte, hopefully they'll be okay. But in the last kind of 10 minutes that we've got here, do you have any kind of like thoughts on where we're headed? Given all of these things that we're testing, that we're working on, that are happening in this space, like what does it look like for you? Get that futurist hat on. What do you think?
I think that, at least I hope that we're going to be able to spend much more time adding value rather than solving problems due to inefficiencies that shouldn't be there.
What's the difference?
And let's for example take the budgets that are allocated within just technology teams at banks, right, or other financial institutions. Like, it's hundreds of millions of dollars in aggregate that are meant to, that they're there to solve a lot of reconciliation problems, where instead of trying to solve, let's call it the problem of that is the problem that is generated by reconciliation, you actually can solve reconciliation itself, and all of a sudden you
Oh, okay.
unlock so much more to do, right?
Is that like let's say reconciliation is a patient that's got cancer, but to solve for the cancer, you just get rid of the patient.
Well,
Is it?
that's kind of what it, well, I'd say more that instead of what you should be doing is trying to solve for the underlying reason,
Yeah.
as opposed to solving for the
The symptoms.
outputs of what that reason is generating,
And I think
right?
we're only doing this right now because these are the tools that we've got available. We've got humans and we can arm them with Excel spreadsheets and coffee.
Yeah,
But
yeah.
without all of that, like, is there a better way, you're
Yeah,
saying?
I think that look, okay, so just futurist hat on. It's not like we have solved all of the problems in society, far from it. And many of those problems we can't solve because we're literally wasting our times solving things that shouldn't be problems in the beginning, right? So instead of fearing that AI took my job, it's more about understanding how AI makes you better so that you can go out and solve real, problems that add value. And it's not until now with this tool that we can have that reframing, let's say, and I think that's pretty cool.
The irony though of like, okay, well, how does AI actually help me? And usually when you go, oh, well, how does this tool help me? How does this service help me? How does this product help me? You've got something in AI where you can actually use the AI to help you understand how to use the AI, and you have this AIception flow. There's many a time. So I do a lot of vibe coding, but it's vibe coding pro or vibe coding plus, I would say, because knowing how to connect to SQL databases in the back end. Like if you've used a CRM, if you're using any kind of system online, there's like a back end system to it where it stores information and data, and there's a front end that you experience. But vibe coding in a way where you can actually build these things that are just like uh, imagined in your head, and all of a sudden you can actually bring them to life. All of a sudden there's this game changer where things that were just too hard basket, I'm not going to create my own CRM for the company, but at NotCentralised we did, because it was just easy enough to do, and we could build in the tools that we needed. We want to add a Google Docs type feature to it, we could create that. Things that were just impossible or too hard basket before now are not. But what it does mean is that you've got these tools as well where you can actually ask the tool to go, given what you know about yourself, what would you make as improvements? And it creates this long list from all of the knowledge that it knows around there. So I think it's going to be really interesting interacting that way. That's the thing I'm excited about. But final 5 minutes, what do you think is going to happen towards like the immediate future? Say for Project Acacia, what happens there to finish it off with the RBA, and where do you think AI plays a role in that?
I think that we have a bit of a perfect storm now where every most of the big organizations are seeing that the sound bites, at least around the value of stable coins, and also how the geopolitics are changing quite dramatically, and the importance of not being reliant on a central clearing party, even globally, i.e. the US, is something that everybody really needs to take into account. And then the concept of a shared ledger allow you to engage with people more in a peer-to-peer way. So that's one driver. The second driver, and sorry, going back to Acacia, uh, the nature of being on a shared ledger gives you the ability to address these different risks. So organizations are already looking at that, and I think that we will be seeing a bigger move towards this new form of financial engagement, which is actually really good. And then the AI piece that is linked to that is that because organizations are actually spending more energy and budget on innovation overall, then the investment into understanding how you actually make human workforce more efficient using AI will be part of that journey, because it's a restacking, right? And you can't do a proper restack. It doesn't make any sense to do a restack unless you start uh, enabling, let's call it, these systems, and more importantly, people, to use generative AI where reasonable, right?
I'm not sure if we've got a slide with our names or anything on there, if there's a default slide for the South by Southwest, but if you want to learn more about the stuff that we're doing, if there isn't one there, is the company that we've got is called NotCentralised. So you can look up that, all one word, and it's centralized in the Aussie way because we're here. Although autocorrect likes to put in Zs everywhere, thank you. We run something called the Australian DeFi Association, that's DEFI, that runs monthly meetups not too far from here at the new Stone and Chalk Startup Hub, 477 Pitt Street. There's another one on October 29th. We do it on Luma. So LUMA, if you go to that and type Oz DeFi Association, you'll find it. Great meetups. Domino's should be a sponsor, but I put thousands of dollars through on pizzas there, free beer and drinks and stuff. But apart from like the NotCentralised stuff that we're doing, you can follow us on LinkedIn. So Arturo,
Come up and reach out.
yeah,
Yeah.
Arturo Rodriguez and Mark Monfort, Monfort, and I've got Chris here, Chris Sinclair, who's helping us with the filming. Chris and I run a podcast on AI called Digital Nexus, and we interview founders. So if you're building something interesting in the AI space, we're keen to chat with you and bring you on the show. We actually have a studio that used to be the CNBC X headquarters. So we have a legitimate like news studio to do this cool podcast that's just started growing. So Arturo,
After that massive plug, any questions?
yeah, I don't think we have time for questions, unfortunately.
Just come up, reach out.
Yeah, we'll be here, guys. I think there's a half-hour break now, but thank you so much for everyone that joined today. Cheers.
Thank you.
Thank you.